Hey guys, I've been seeing a lot of back and forth recently online about Duolingo, if it's a buy, a hold, or a sell. So I just wanted to take a few minutes and share my thoughts on how I view Duolingo. So what's the deal with Duolingo? What's going on? If you haven't heard, they've lost about nearly 50% of their value in the past 3 months. Actually, as of making this video right now, Apple had just announced that they're doing a language translation through the AirPods. And this Duolingo is seeing a pretty harsh spike right now. It's starting to slightly recover, but down a good 3 to 4% here on the day. Interestingly enough, from my perspective, revenue, profitability from free cash flow perspective have all stayed the same, and management is still giving strong guidance over the next 3 years for growth. Um, looking over the chart, and I have some items here that are just quick highlights that aren't on the chart, but they have 116 million monthly users, 9% of those being paying customers, for the paid version of the app. 1 billion lessons are completed every day, and they have retention rates that are higher than TikTok. Um, Finally, the company has recently turned profitable, but the AI tutoring threat and the language, conversion through the Apple AirPods are threats that, do exist. But in my opinion, the app is much more comprehensive, and the design and the marketing behind it is much more powerful. The company has no debt and over 1 billion in cash on the balance sheet. So we'll have to wait and see, but it seems like Duolingo from these news headlines, could potentially be pivoting towards becoming more of a immersive platform, based learning ecosystem and not just a language app. Just reading from the highlights below, they'll be on 9/16 unveiling new video call features, expanded energy system, non-language learning offerings, to aim to boost the user engagement because this first quarter was their most recent earnings report showed the first decline in monthly annual users. Um, it kind of is reminiscent of Netflix a while back missing their monthly annual users count and the stock overreacting. And if you look on the 5, 10 year chart, you don't even notice it anymore. So just to highlight some of the key features here of Duolingo, um, this isn't, in my opinion, what a struggling business looks like. You can look at the gross profit margin has increased over time, basically staying flat, which is the topmost line. The blue dotted line you can see is the free cash flow margin on an LTM basis, going back quarterly from an LTM perspective, and you can see it increasing steadily over time. And lastly, you can see the revenues over time steadily increasing. I mean, to me, it does not warrant such the decrease in the stock, but we'll look at that from a discounted cash flow analysis at the end. Here are some interesting tidbits. Half of the Duolingo users open the app daily. It's more than X and Reddit. It's just narrowly behind TikTok. It's almost a social media app at this point. So real quick, looking at the Rule of 40 score benchmark here, this Rule of 40 is based on revenue growth and the last 12 months free cash flow margin, and all of the green ones over the line are what's over 40%. And interestingly enough, you can see near the top right, it's about the third one. Third highest is Duolingo. These are the type of risk reward situations right now, with strong companies, strong guidance, strong earnings, who's down right now on stories is a potential for upside gains. And here's the Duolingo subscription revenue, which is compounded quarter after quarter, now crossing the 200 million mark here. The 2 year compounded annual growth rate would be 49%, just a tad over. Whatever the narrative is now and the story, the underlying engine of the company, keeps on moving forward. So, in a recent interview with management, Duolingo said that they believe they can get to 1 billion monthly annual users. Projecting that over time, you get the 1 billion here in the terminal period because that's where they expect, they'll basically max out and then inflation takes over from there. They won't really grow, they won't really shrink. That's the terminal period. Right now, they're at 116 million annual users. You can see that in the 2025 actual column. From the 2026 and 2027 is from the revenue estimates based on management from guidance over the next 2 years, which is about 30% increases. So that would leave us, at about 151 million users and then 196 million users for Duolingo in 2026 and 2027. Going from 2028 to 2020 to 2034, we're kind of taking our best guess here of how it's going to grow to that 1 billion. In my opinion, the 10 years is a fair time frame if the first 3, 4 years is going to be spent at 30% growth from management and then, kind of tapering off at 30% and then 25, 20, 15, 10 until you get down to the terminal. And then the next component we have to project would be the target average revenue per user. Right now, it's currently at $6.44 about they make off of a user. So, once we can project that from guidance, we know that, you know, at the high end, it's going to be $8. We can conservatively guess in our terminal about 7.10, and then we slowly build up over time to that 7.10, as you can see in the same kind of time frame that they're building the build up of the monthly average user base. So if you multiply, just for example, in 2026, the 150, point 8 million monthly annual users times the $6.50 target for the average revenue per user, you'll get revenue of 980 million. The revenue line there stated in millions. So then you take the free cash flow, which was 36.8% in 2025, and you go outward and projected from guidance from management believes they can hit about 42% in free cash flow in their terminal and when they're at capacity. So, slowly incrementally growing that over time and during these same transition years with the user base growing, lining it up and growing it outward, we get free cash flows ranging from 382 million all the way up to 42 billion in the terminal year, which would represent every year in the perpetuity from 2036 on to the end of the company's growth. Um, if you don't know much about discounted cash flow analysis, you can look up the terminal period. It's extremely important, obviously, because that's where all the value or most of the value is going to be coming from, even after it's discounted back at the 40% at the mid-year convention because it's so far into time, right? A dollar today is worth more than a dollar tomorrow because of the opportunity cost and return you could use to invest that dollar today versus tomorrow. So basically saying, I could invest $1 today, $100 today at 6% and make $6 and over a couple of years make more money. But if I didn't have that $100 for 50 years, that $100 you can actually calculate with the mid-year convention formula exactly in today's dollars, assuming a rate of return you can expect from the market. At this instance, we're using 10%, what it'll actually yield back over time, the formula being 1 divided by 1 plus the discount rate raised to, then it's a mid-year convention because we want to assume companies are assuming their cash flows evenly throughout a year. If they receive it at the beginning or the end, that will manipulate or make conflate the value upwards or downwards. If you assume a company assumes its cash flow is received in the middle of the year, it's the fairest assumption you can make of them. So uh, again, so that formula will be 1 divided by 1 plus the interest rate raised to the half a period, and then every period after that is plus ones, and the next period would be to the 1.5, to the 2.5, to the 3.5, and then the terminal period is always set equal to the last period. But this is all stuff you guys can look up. This isn't really the video for it, but I just figured I could kind of expand on it if you're kind of 42 million in the terminal, what's that? It's perpetuity, it's for everything. So, the sum of the present value of these free cash flows here is about 25.3 billion. They have about 1 billion in cash, and they only have about 97 million here in debt. That gives you an enterprise value of 24 billion, and enterprise value is what you want to look at instead of the market cap, right? Because if you were to actually buy the company, you're going to assume the debt and the cash, right? So that's why the cash is negative, because you assume that cash, you can use that to pay down the debt. So that's why the sum of the free cash flows is actually 25.3 billion, but the enterprise is actually lower at 24.3, because if you were to actually buy out this company outright, you could take all the cash and pay down the debt and come out net ahead of the sum of the free cash flows, because there's more cash than debt, net debt. You guys can just look up that. So with a rough estimate of their shares they have here, and gives you a target share price of about 533.16 on the conservative end. I know there's, um, you know, a nice margin of safety here of about 96% for the stock. I just think there's unique opportunity when there's strong fundamentals, and the, engine beneath the company's story and headlines, keeps moving on forward. There, is a nice risk reward bet to take that could prove out to give you a nice return.